In this video, we are going to take a look at some different options we had prepared for the wife. So what we'll look at for the wife is whole life insurance policies set up for maximum cash value, but we're going to look at a couple different funding scenarios and some different products as well. So what we have here, we are looking at Mass Mutual for her. We looked at Guardian for the husband. And when it comes to Mass Mutual, we have flexibility, but it is not quite the same as Guardian's. So if you had a chance to view Guardian's video, do you remember how their flexibility works? Meaning if you're interested in a Guardian policy and you want the option to pay up to $100,000 per year, what can you do? Well, you can easily commit to $10,000 per year. Then at your discretion, you can just throw more money into the PUA rider, which accelerates the cash value growth. And that can be through your online portal, mobile app, very, very flexible. And that's with Guardian. So with Mass Mutual, you do not have the same option to add PUAs at leisure, meaning I cannot just log on to my online portal and throw money into PUAs every single week if I wanted to, like what I can do with Guardian. Not as flexible in that respect, not yet at least. Perhaps in the future, they will attain that same flexibility or offer it, I should say. When it comes to flexibility, they've got a couple different PUA riders, but if you properly design a Mass Mutual whole life insurance product, you can easily make payment adjustments without any medical underwriting, one time per year, every year, provided the adjustment occur on your policy anniversary date, which is a fancy word for your premium due date. So for example, if your payment is due, let's say January 1st of each year, then each year when it is due, you can adjust the total amount that you'd like to send into the company. So you may have a policy where you're committed to $10,000 and the maximum you can pay in is $100,000. How it works, however, is like this. Let's say the first year, you paid in $100,000. And the second year came, things slowed down, and you scaled your payment down to $20,000. What this means is the premium piece is still $10,000. That's consistent. So think of it this way. In the first year, if we break it down like this, of that $100,000, you had $10K that went toward the premium. And then $90K that went toward PUAs. And then here in the second year, the premium is constant at $10K. But now because your total payment is $20,000, the other $10K went toward PUAs. And then you can make that adjustment every year on the premium due date, and as long as the adjustment is made then, there's no medical underwriting. Meaning you say, here's the dollar amount I'd like to pay into the policy, we make the adjustment on the back end, or your agent does if you're working with an agent, and then you can send the funds in. Here's the key, however, with Mass Mutual, in order to have this option where you can make the one-time payment adjustments, this is a must. That must be attached. LISR, which represents Life Insurance Supplement Rider. If it's not attached, you're subject to their ordinary AILR rules, which may result in you having to go through medical underwriting before you can add more funds. So the purpose to this additional detail is really to emphasize the initial design of the product when you're working with your agent is so critical, because if it's not done right, that's what results in situations where someone wants to add more money and they're told you can't. Or you have to go through underwriting first. A nurse comes out, takes blood and urine when you just want to dump money into a life insurance policy. It's like, what? Do they not want my money? What's going on here? So the initial design is critical with Mass Mutual policies. If you get the design right, it's smooth sailing, assuming you understand the rules of the game as well, as far as what you can and cannot do with your product. And that's the case with any company. So the two products we'll look at are as follows. We've got their 15-pay policy and then their high early cash value product. Couple key points here. Their 15-pay product, both their 10-pay and their 15-pay product have lower PUA fees than all of their other whole life insurance products. Also, the 10 and 15 pay product generate stronger internal rates of return on cash value, than all of the other whole life insurance products. So if someone is interested in getting the strongest internal rate of return, which is the strongest growth rate on their whole life insurance product, and they like MassMutual, the 10 pay, that'll be number one, and then the 15 pay, that'll be a close second. Those two products will deliver that, the strongest overall IRR and cash value, highest growth rate. Now, their high early cash value product is great for strong year one cash values. In addition to that, the high early cash value product, I can pay into it up until the age of 85. Guess how long you can pay into a 15 pay policy? Premiums are due for a maximum of 15 years. If we go back to the intro video of this series, what were some questions that they had? How long should I fund? A specific question the wife had asked was, how long should we pay into it? What are the benefits to funding a policy for a short period of time? Say it's 5 years, compared to a policy where I can pay into it for 30 years. Wanted very specific details. So in the phone, I let her know, well, with a life insurance policy, if you're funding it for 7 years or less, you will see the strongest internal rate of return on cash value. If I fund a policy for a short period of time, then exercise what is referred to as a reduced paid up option, you will see strong IRRs on cash value. However, if you like the idea of pumping money into a policy for a long period of time, a lot of people will do that. The IRR might be slightly less, but I'm getting more money into cash value. So I like to explain it this way. I can have a policy where if I'm interested in a high IRR, I'm just going to use round numbers here, say 5%, I can fund it for 5 to 7 years and then stop. And that might give me a 5% IRR. Compared to an option where I say I want to keep adding money, so my IRR might be at 4.5%, but I decide to fund it for 30 years. And naturally, if I fund a policy for 30 years, I'm going to get a lot more money into the product than what I would have gotten into the product over 5 years. So the question then is, do I prefer to get a higher IRR on a smaller bucket of money or a lower internal rate of return on a larger bucket of money? And every situation is different. It's very common to see individuals who have a large lump sum of money. Maybe they've got 4 million in cash or several million. They say, okay, I just want to get this lump sum of cash into a whole life insurance policy and never make another payment. After that, I'm done. So what we'll do in a case like that, when we're funding a policy with a lump sum, is call it that $4 million into a policy at $1 million per year, that's 4 years, and then stop. Exercise that reduced paid up option in year 8 and just get as much cash value growth as possible out of the dollar amount that I have to work with. However, if someone says, well, I don't think I want to do that, I might want to continue to add money into the product, then what are we going to do? We're going to show an option that allows them to continue to add money into the product. So a big reason to showing these different products is the goal is A, maximize the cash value, but not being sure how long they'd like to pay into it. I might just show a high early cash value in this particular case, but just as I looked at the numbers, thinking, okay, if I'm them, if we flip positions, I would definitely want to see this 15 pay product, the stronger internal rate of return, and then make the decision. Where people often have buyer's remorse when selecting products, and this is not just in life insurance, it's in many industries, is when someone purchases a product and then they find out after the fact another product existed, but they were never shown that option, and they think, boy, I really would have liked to have seen that, but so-and-so never showed it to me. Or they say, I really would have liked to have seen that because I would have picked that option. So we have to be able to put ourselves in the individual's shoes, the client's shoes, and show those options, provide enough information, but at the same time not be overwhelming. In this particular case, when working with someone who's very, very technical, an engineering background, who wants details, we can get into the weeds, because often from experience, the individual wants the weeds. They want to know how the watch is built to make sure they understand it and then can make an informed decision. So with respect to the funding, how much? We'll look at different dollar amounts, how long, and then we will look at a performance review comparing these two products, the 15 pay and the high early cash value product. So let's take a look. What we've got up here is the high early cash value product, and we're going to go through some of the details here. So top right-hand corner, we see high early cash value product with LISR. It's very important for flexibility. Remember that term. Life insurance supplement rider is what it represents. The funding, annual net outlay, $125,000. What is your first year cash value? A lot of columns here. Is it this column? No, it's this column. Total cash value end year. That is your total cash value. I like to refer to this as your money column, the money you have access to. Other important columns. Total death benefit beginning year. If I die, that's the life insurance benefit that's paid out to my beneficiaries, income tax free. Now here's the important piece. We've got $125,000 paid into the product in the first year, and then $100,000 per year thereafter. Am I required to pay this $100,000 into the policy every single year? I am not. Where's the money going? Here's my premium, $12,500. The goal was to commit to $10,000. Can't quite do that with this product. Not with Mass Mutual. With Guardian, you can, based on their limits. They allow large PUA payments in the first year. I can go up to 50 times the base premium. Mass Mutual does not. So we've got a base premium that's slightly higher than the $10,000. So we have to confirm if that's okay with the client. If it's not, then we look at paying in a little bit less in the first year. Maybe we spread that lump sum up over the first and second year, or look at a different company if that's not an option for the client. But here we've got the premium at $12,500. And then we've got different riders. So LISR represents life insurance supplement rider. We see face amount. This is term insurance that is attached to the policy. And we see $7,500. This is not the cost of the term, I promise you that. A small dollar amount goes toward term, and then everything else goes toward PUAs. Then we have AILR. That represents additional life insurance rider. Here we see $80,000. That's a pure PUA payment. And then you see a lump sum of AILR, unscheduled AILR, $25,000. So as we look at this guy, what do we see? $125,000 in the first year, $100K. Total payments are at $225,000, $325,000, $425,000. There's your cash value, $423,000. The next year, $525,000. Cash value is $535,000, which means your break-even point is between years 4 and 5 in this particular example. Now, one thing I want to hit on here, this death benefit, $2.9 million and change. That ever annoy you? The fact that you have an oddball death benefit? Maybe not. I know some people get annoyed by that. They're like, make it an even death benefit. Why not round up to $3 million? We can round up to $3 million, but here's where we came up with that number. The bottom right-hand corner of the illustration, there's our MEC limit. So what this represents is the maximum dollar amount she can pay into the policy every year without triggering a modified endowment contract, a taxable event. I want to make sure I've got access to the cash value tax-free all the way through. So what has a direct relationship to that MEC limit is, guess what? The total death benefit on a policy. So where we came up with this death benefit is we solved for a MEC limit of slightly greater than $125,000. And why I say 125 is because that is our first year payment. Okay, and then here we have an example where we fund the policy for 30 years and then stop after that point in time, although she has the option to keep going. So that's a high early cash value product. If we look at our 15 pay policy, here we go. Similar design. When we look at the base premium, what do we notice? $12,500 on the base premium. A lot of similarities here. There is one difference. you'll see this term here, renewable term rider. This is an additional term insurance rider we added to the policy. Another $750,000 compared to the other term rider we have, the lister component on the policy. And the reason why is with a 15-pay product, we actually need to do that in order to get the death benefit high enough to attain that same MEC limit. And you'll also notice the death benefit here is 2.4, whereas the high early cash value, it was 2.9. So naturally, an engineer or someone very, very technical is going to ask the question, you said, Steve, that the death benefit has a direct relationship to the MEC limit. Why are the death benefits with products with this exact same company different, but the MEC limits are the same? And the reason why, another element that impacts the MEC limit on a life insurance policy is the guaranteed rate. The guaranteed rate on the 15-pay product is 2.5%, whereas the high early cash value product, it's 3%. The lower the guaranteed rate is, the less death benefit I need to attain the same MEC limit. Very fun stuff, isn't it? It can be quite complex. But aside from that, let's get back to the bottom line. By year 4, I've paid in $425. If she gets ultra preferred, that's going to show a break even of year 5. This is run at select preferred, which is the second best class. And man, we are right there. 425 in, she's got 424, 797. And then by year 5, she's got 540. Do you remember what the high early cash value product was in year 5? It was 535. So by year 5, we already see a $5,000 difference here. And this 15-pay product will pull ahead. Here's the big decision-making point, though. We can only pay into this for 15 years. She will be 53 at that point in time. Here's the question I would ask. Do you want to fund a policy for more than 15 years? Do you think that's realistic? Based on where you're at in life right now, I know things might change, but do you think you might want to fund longer than 15 years? If the answer is yes, I would consider the high early cash value. If the answer is maybe, I would consider this product. And the reason why is we can pay into it for 15 years. And if you find out in 3 years, 5 years, 10 years, at any point in time that you want to fund the policy longer than 15 years, I might add a new policy. However, I don't know that I would be quick to go with the high early cash value compared to this if you think the chances are very low that you'll want to fund longer than 15 years. Because you will notice a difference when we compare the 15-pay and high early cash value, just when we look at the total cash value through the 15th year and the internal rate of return. All right, so here we go, high early cash value. What's cool about this, we've got the same policy here, all funded at $100,000 per year. So this is a heavy fund scenario. We've got the lump sum in the first year, $125. There's your cash value at $115. You've got your annual internal rate of return, and then your average internal rate of return. Your annual internal rate of return represents what your cash value is growing by each year. So when it's in the red here, when it's negative, you'll notice years 1 and 2, I paid in 125, then 100, and I got less back than what I paid in each year. For example, I paid in 125, I have 115, which is about a 7.5% loss. The next year, I paid in 100. If this went under my mattress, if I had 115 and added 100 to it, what would you have? 215. However, you've got 213, almost 214, but that's why I see a loss there. The next year, in year 3, I pay in 100K, I get that back and a little bit more, which is why it is positive beginning year 3 on the annual internal rate of return. Here, we stop funding altogether after 5 years. Look at the 5th year, the next 2 options, and tell me if you notice any difference with all 3 of them. You won't, because it's the same policy. One of the advantages to Mass Mutual, if someone wants the option to fund a policy for a long period of time, but they're not sure they want to do that. They just want that option, and they might want to stop after 5 years as well. This couple specifically asked about that. You can do that with Mass Mutual, provided the policy is designed properly. But here we go. Same policies, just different illustrations displaying what things look like if I stopped funding after 5 years, 15 years, or 30 years. And now we get to see a side-by-side that we can analyze. She can analyze on her own time as well, and then we can begin to make adjustments as well. But that's the high early cash value product. Then we've got one example of the 15-pay product here. What this displays on the left, 125 in the first year, 112 in year 1. But then funding of $15K per year through year 15. When's your break-even point? Year 5. Next example, same policy. Look at your first year cash value, 112. However, years 2 through 15, we're funding $100K per year. When's your break-even point? Now you're between years 4 and 5. And then how about over here? 100 grand per year through the 15th year, max funding it. And this can be adjusted each year. Some years she might pay 30, then 50, then 100, back up to 125. She can fluctuate the dollar amount each year. We just ran consistent amounts just to show here's a consistent dollar amount going in, and then here are my total payments over time. Break-even point, very close to year 4 in this example. Now, a question that sometimes comes up here is this. Look at year 2 on the annual internal rate of return. You know why that is? Specifically, the examples where you pay more money into the product, you have a lower internal rate of return, but then at the same time, you break even earlier, your average IRR is stronger. Why is that? The reason why is when I add more money into PUAs, there are PUA fees or PUA loads that are associated with the product. Now I'm also compounding. I'm receiving the guaranteed rate and any dividends, but when I make PUA payments, especially in the early years, when those expenses are still exceeding the gains I'm receiving, a large PUA deposit results in that fee on a larger bucket of money, a larger deposit. That's why I see that annual IRR for that particular year weaker. Now, with that said, the method to maximize the cash value on a policy is what you see over here. Max funding it year in and year out, particularly for the first 3 to 4 years in her particular case. At her age, if she max funds it for 3 years and then stops or pays just the premium, meaning she doesn't keep on max funding it, she will see a strong internal rate of return. But if I'm max funding it, that does put me in a very, very beneficial position. Even though I see I'm slightly behind in year 2, isolating the internal rate of return, after that, you'll see it just get stronger and stronger as time passes. And the average internal rate of return will demonstrate that, and that average IRR just takes into account all years. Like what's the IRR, the average over 10 years, 20 years, 30 years, that's what that displays. Here's an example with the 15-pay product, funded for 15 years, and then funded for 5 years. The option to continue to pay into it through the 15th year. So again, this is meant to demonstrate that she can adjust as time passes. Let's take a look at a side-by-side here. So if this was you, would you go with the option where you can fund for a maximum of 15 years, being the 15-pay, or would you go with the high early cash value product where you can keep going, but you see a lower internal rate of return? And the answer, if I was you, would be I would need to see it. So the IRR is good to look at here. However, let's do this. This will make life a whole lot easier. Cash value difference, and we'll use the HEC fee, the high early cash value. So what that means when I say use the high early cash value is the number you're about to see here will represent how much more or less you have in cash value in the high early cash value product directly compared to the 15-pay product. There we go. First 3 years, you've got more. From that point forward, significant difference. Same company, same dividend rate, different products. So from an awareness standpoint, that's important to be aware of, isn't it? Now, if you select the high yearly cash value product, what you have here is the ability to keep adding money. Premiums are no longer due after 15 years with a 15-pay policy. But if you think the chances are slim to none of wanting to continue to make payments beyond the 15th year, well, that difference is noticeable. So that's what I want to be aware of upfront more than anything else. So that's what we'll look at as we compare different options. And again, the choice is ultimately up to the individual. The big question here to simplify things for this case is really, how long do you want the ability to pay into the policy? If you think it's longer than 15 years, I'd lean toward that high yearly cash value product. However, your gut reaction when I say, do you think you want to fund it for longer than 15 years? If it's, I don't know, or I don't think so. How about 10 years? Yeah, 10 years seems realistic, maybe a little bit longer. Okay, it sounds like the 15-pay might be a good option. Of course, here they are side by side, but I would just ask yourself questions out loud. That always helps me to know, okay, realistically, would I want to do this? Because in my mind, I think one thing, then I say it out loud. I'm like, you know what? No, this is the direction I want to go. Hopefully you don't think I'm nuts when I say that. But in any event, that's the main thing to decide, assuming she selects MassMutual. How long do you want the option to fund? And then we'd start to narrow down the design and product from that point in time. So I hope you enjoyed this video. If you did, please hit the like button, subscribe for more. Please leave any questions in the comments below. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.